Imagine waking up one day and realizing that every dollar you thought was safe is slowly being taken away by new laws you never voted on. These rules don't make the headlines, but they strike where it hurts most. Your home, your savings, your retirement, even the price of your daily necessities. Millions of families could be blindsided as these policies creep into everyday life, draining accounts little by little. But here's the truth. Knowledge is the only defense. Today we'll break down the 10 laws that could quietly cost you everything, so you know what's coming before it's too late. Number 10. Federal Consumption Tax Proposals. The idea of a nationwide consumption tax has been gaining traction, marketed as a simple replacement for complex income tax systems. Yet behind this polished pitch lies a policy that could dramatically raise the cost of everyday living. A flat tax applied at the point of sale would not distinguish between luxury goods and basic necessities. That means food, clothing, medicine, and school supplies. The essentials every family depends on would all become more expensive. While a small percentage may seem harmless, the impact compounds with every purchase. For households already stretched thin, the result is not minor inconvenience, but ongoing financial strain. The burden of a consumption tax falls most heavily on low and middle-income families, who spend a larger share of their earnings on essentials. Wealthier households, by contrast, can save and invest more, reducing their exposure to daily expenses. This makes the tax inherently regressive, hitting hardest those who can least afford it. Critics warn that the supposed fairness of everyone paying the same rate disguises a deep inequality. The working class pays proportionally more of their income just to survive. A family of 4 buying groceries, gas, and school clothes could see their monthly costs soar, even if their income remains unchanged. What looks like a simple reform on paper translates into a relentless drain in practice. The ripple effects extend into the broader economy. Higher consumer costs mean reduced spending power, which in turn slows small business growth and weakens local markets. Families forced to cut back on discretionary purchases like dining out, entertainment, or travel unintentionally harm industries that rely on steady consumer demand. Meanwhile, large corporations with global operations adapt by shifting profits abroad, avoiding much of the impact. Once again, the pressure falls on ordinary citizens. By framing the tax as a streamlined solution, lawmakers sidestep the harsh truth. A federal consumption tax reshapes daily life, making survival costlier at every turn. Instead of simplifying the system, it risks destabilizing household budgets, widening inequality, and placing the weight of reform squarely on the shoulders of those least able to bear it. Number 9. Social Security Tax Adjustments. For decades, workers have trusted that their contributions to Social Security would guarantee stability in retirement. Yet looming adjustments to payroll taxes threaten to take a bigger slice of every paycheck. Lawmakers argue that expanding the tax base is necessary to keep the program solvent. But the reality is that ordinary workers will bear the heaviest burden. Higher income brackets may see their contribution limits lifted, but proposals also extend to middle-income earners, meaning millions could watch their net pay decrease. For families already juggling mortgages, student loans, and everyday expenses, these adjustments make survival even harder. The promise of long-term benefits feels distant compared to the immediate sting of smaller take-home pay. The effect goes beyond numbers on a pay stub. With every adjustment, workers lose not just income but also the sense of control over their finances. Imagine planning carefully for childcare, groceries, or rent, only to see hundreds vanish monthly into mandatory contributions. Supporters argue this ensures the longevity of Social Security, but critics highlight the uncertainty of ever receiving those benefits. Rising life expectancy, shifting demographics, and political debates raise doubts about whether today's contributions will ever return as promised. In this light, the payroll tax feels less like an investment and more like a forced withdrawal from hard-earned income, with no guarantee of repayment. These adjustments also deepen divides in the labor market. Wealthier households often supplement retirement through investments, while small business owners may structure earnings to minimize payroll obligations. Meanwhile, regular employees, teachers, nurses, service workers, shoulder the brunt of the increases. Over time, this erodes morale and fosters resentment, as citizens feel they are paying more while receiving less. The narrative of protecting Social Security masks the immediate reality: shrinking paychecks, rising financial stress, and growing doubt in the system's sustainability. By targeting everyday workers, lawmakers risk undermining trust in one of America's most iconic programs. What was meant to provide security may instead create frustration, as families struggle to reconcile their contributions with an uncertain future. Number 8. Small business regulation fees. Starting a small business has long been celebrated as the cornerstone of the American dream. But a surge of new regulation fees threatens to dismantle that vision. From mandatory licenses to compliance charges, entrepreneurs now face a growing list of expenses before they can even open their doors. What was once a straightforward process of hard work and determination has turned into a maze of red tape and financial hurdles. For many, the fees add up to thousands of dollars annually, consuming profits that might otherwise support growth or employees. Instead of encouraging innovation, these rules quietly discourage ordinary citizens from pursuing independence. The impact of these regulations is particularly harsh on local businesses, which lack the resources of large corporations. While big companies can hire lawyers and consultants to manage compliance, small shops and startups must absorb the costs directly. This means higher prices for customers, lower wages for workers, and in many cases closures before a business can ever become stable. Studies have shown that regular expenses often represent a larger percentage of revenue for small firms than for larger competitors, creating an uneven playing field. The result is fewer new businesses in communities, reduced competition, and the slow erosion of local economies. Ironically, the very laws designed to protect consumers often strip them of affordable, diverse options. Beyond economics, the personal toll is immense. Entrepreneurs invest not only money but also their dreams and energy, only to watch them drained by hidden fees. The stress of navigating complex paperwork and ever-changing requirements discourages risk-taking and innovation. Instead of celebrating entrepreneurship, the system punishes it, ensuring only the most financially secure can endure. Meanwhile, communities lose the vibrancy and character that small businesses bring. A cafe, a bookstore, a family-owned repair shop, all risk being priced out by endless fees. By layering regulation on top of regulation, lawmakers unintentionally create a hostile environment for the very people who drive economic diversity. The cost of compliance becomes the cost of survival, and the dream of independence fades under the weight of government-imposed expenses. Number 7. Carbon and climate fees. As environmental concerns rise, lawmakers are introducing new carbon and climate fees designed to curb emissions. While the intention is to protect the planet, the practical effect often lands squarely on the shoulders of ordinary families. These fees are attached to energy production, transportation, and even manufacturing. Every gallon of gasoline, every kilowatt of electricity, and every truck delivering groceries carries an added surcharge. That cost is rarely absorbed by corporations. It is passed down directly to consumers. Families already struggling with high utility bills suddenly find themselves paying significantly more, turning basic necessities like heating, cooling, and commuting into constant financial stress. The hidden impact of these laws lies in how they ripple through the entire economy. Increased transportation costs mean that food and household goods arrive at stores with higher price tags. A weekly grocery trip that once felt manageable becomes noticeably more expensive, forcing households to cut back on essentials. Critics point out that while wealthier citizens can adapt through solar panels, electric cars, or energy-efficient homes, low- and middle-income families are left with no such options. They must continue using traditional fuels and infrastructure, which means they pay disproportionately more under climate fee structures. The result is not just higher bills, but a widening inequality gap between those who can afford to adapt and those who cannot. Perhaps most concerning is the unpredictability of these fees. They are often tied to global energy markets, meaning a political crisis or natural disaster can cause sudden spikes in cost. Families planning their monthly budgets may be thrown off by unexpected increases, leaving them scrambling to cover shortfalls. Supporters argue these measures are necessary to address climate change, but the reality is a system where the environment is used as justification for yet another household burden. Instead of encouraging innovation and providing relief for ordinary citizens, the policies risk punishing them for problems largely created by industrial giants. By embedding carbon and climate fees into daily life, lawmakers ensure that survival itself, eating, heating, traveling, becomes more expensive than ever before. Number 6. Health insurance mandates. Healthcare in America has always been expensive, but new health insurance mandates are making it even harder for families to stay afloat. Under these rules, Individuals who fail to maintain approved coverage may face escalating penalties, while premiums themselves continue to climb. What was once a matter of choice is now enforced by law, leaving households trapped between paying thousands for coverage they may barely use or facing government fines. For families already struggling with groceries, housing, and energy bills, the added burden of inflated health costs can feel crushing. Instead of guaranteeing peace of mind, the mandates risk pushing millions deeper into financial instability. The complexity of the system adds to the frustration. Many policies that meet mandate requirements come with high deductibles and limited provider networks. Families may spend thousands annually only to discover that basic services are not covered, or that out-of-pocket expenses remain unaffordable. Critics argue that the structure benefits insurers more than patients, creating a system where compliance is costly and relief is scarce. Those who attempt to skip coverage entirely face not only penalties but also the terrifying prospect of uncovered emergencies. A single hospital visit could wipe out years of savings, making health insurance less of a safety net and more of a forced gamble. Ordinary citizens find themselves stuck, with no real choice but to comply with laws that leave them paying more yet receiving less. The ripple effects stretch beyond wallets. Employers are pressured to offer coverage, often passing the costs on to workers through reduced wages or limited benefits. Small businesses, already strained by regulations, may struggle to survive under the weight of mandated plans. The end result is a cycle where workers pay more, businesses shrink, and families feel increasingly cornered. Meanwhile, larger corporations and wealthy households adapt with specialized plans and tax strategies. Once again, it is the middle class that shoulders the burden. By framing these requirements as necessary for public health, lawmakers disguise the reality. Health insurance mandates function as another hidden tax, draining money while offering little in return for those who need it most. Number 5. Property tax surges. For many families, owning a home represents stability, pride, and the ultimate symbol of achieving the American dream. Yet a wave of rising property taxes is threatening to turn that dream into a financial nightmare. Across the country, local governments are reassessing property values at higher rates, and with every reassessment comes a steeper tax bill. Homeowners who purchased modest houses years ago are suddenly shocked when their taxes double or even triple. For retirees living on fixed incomes, these increases can be devastating. Instead of enjoying the comfort of a paid-off home, many are forced to sell because they cannot keep up with the annual tax burden. The surge in property taxes is often justified as necessary to fund schools, roads, and community services. While these goals sound noble, the hidden truth is that middle-class families carry the brunt of the cost. Wealthier households have the resources to relocate or contest their tax assessments through legal appeals, while ordinary families have little recourse. The effect is a growing sense of insecurity. Families once confident they could pass down a home to their children now wonder if escalating taxes will force them to part with it. Rising housing costs also ripple through the rental market, as landlords pass on the burden to tenants, driving up rents in already strained cities. The cycle ensures that whether you own or rent, you feel the weight of these surges. What makes the situation even more concerning is the unpredictability. Homeowners cannot plan effectively when property tax hikes arrive without warning. A family saving for college or healthcare suddenly finds thousands diverted to taxes. This unpredictability discourages long-term stability and punishes those who play by the rules. Communities fracture as long-time residents are pushed out, replaced by developers or investors who can absorb the costs. The result is not just a financial issue but a cultural one, as neighborhoods lose their history and identity. By allowing unchecked property tax surges, lawmakers risk destabilizing families, uprooting communities, and undermining the very foundation of homeownership in America. Number 4. Retirement account restrictions. For years, 401k plans and Roth IRAs have been the backbone of retirement planning in America, offering workers a reliable path toward financial security. Yet new legislative proposals are tightening the rules on how much you can contribute, when you can withdraw, and what penalties apply. Imagine working decades, saving diligently, and then discovering that your access to those savings is blocked by new restrictions. Early withdrawals may face even harsher penalties, while contribution caps mean you can save less each year. For families counting on these accounts as their safety net, these limits could transform retirement from a time of rest into a period of constant financial anxiety. The complexity of these laws also makes them a hidden threat. Small adjustments like reducing the contribution limit or raising the penalty percentage may not sound dramatic, but over time they erode wealth. A saver who once expected to retire with $1 million might now see hundreds of thousands lost to taxation and penalties. The danger is not only in lost funds but also in lost opportunities for compound growth. Money that could have grown for decades is instead siphoned away, leaving retirees more dependent on fragile programs like Social Security. Advisors warn that many people underestimate the long-term effect of such policy changes, only to realize too late that their nest egg is insufficient. Beyond the financial math, the psychological toll is equally heavy. Retirement accounts represent security and independence, and when laws make access more restrictive, that security is shaken. People may delay retirement, work longer hours, or take on part-time jobs to compensate. The dream of enjoying later years becomes overshadowed by fear of running out of money. Meanwhile, wealthier individuals with diverse portfolios and professional advisors remain insulated from most of these changes, widening the gap between classes. The restrictions meant to stabilize the system end up punishing those who followed the rules most faithfully. By placing tighter controls on retirement accounts, lawmakers risk turning the future into a cage, one that keeps ordinary Americans locked away from the savings they worked so hard to build. Number 3. Student loan forgiveness offsets. For millions of Americans, the promise of student loan forgiveness felt like a long-awaited breath of relief. Years of struggling under the weight of rising tuition costs seemed finally to be acknowledged by policymakers. Yet hidden inside this hopeful message is a troubling reality. In several states, forgiven loans are treated as taxable income. Imagine celebrating the cancellation of $20,000 in debt, only to be handed a tax bill of several $1,000s the following year. The celebration quickly turns into panic, as families who were barely keeping afloat find themselves facing another financial burden. Instead of lifting people out of debt, the structure of these forgiveness programs risks pulling them back into a cycle of repayment, this time to the government itself. The problem extends beyond numbers. Many borrowers, especially young professionals just starting their careers, are caught off guard by the complexity of these tax codes. Few realize that loan cancellation may be classified as a form of income gain, even though no money ever enters their bank account. This means taxpayers are essentially punished for having their debt forgiven. To make matters worse, the IRS offers little flexibility on repayment deadlines, which can force individuals to take on new loans or credit card debt just to cover the taxes owed. Families who thought they had escaped the weight of education costs now face mounting bills that threaten their financial stability all over again. This law doesn't just affect individuals, it reshapes the broader conversation about access to education. If forgiveness programs come with hidden penalties, fewer students may feel confident pursuing higher education in the first place. The dream of advancement through schooling becomes a gamble, where relief today could mean a surprise liability tomorrow. Wealthier households can absorb the shock or hire advisors to navigate exemptions, but ordinary citizens are left vulnerable. The very system designed to provide opportunity risks becoming another trap. By labeling forgiveness as taxable, lawmakers ensure that relief is only partial, and the cycle of debt continues to shadow millions who believed they had finally broken free. Number 2. Inheritance and estate tax expansion. For decades, the estate tax was something only the ultra-wealthy had to worry about. But new legislative changes are pulling middle-class families into the crossfire. Under the updated framework, the exemption threshold is shrinking, meaning more families will find themselves owing the government after the death of a loved one. What was once a simple inheritance of a family home, farmland, or small business could now be treated as a taxable asset. This means children inheriting their parents' house may face a hefty tax bill just to keep it. If they cannot pay, the property may have to be sold, breaking the generational chain of ownership. The law is presented as a way to ensure fairness, but in practice, it often punishes families who work tirelessly to build modest wealth. The real burden becomes clear when you look at the ripple effects. A family business passed down through generations can suddenly become a liability. Instead of providing stability, the handover could lead to crippling financial stress. Legal experts warn that the administrative costs alone, filing paperwork, hiring tax professionals, and negotiating with authorities can drain thousands of dollars. Families grieving a loss are forced to deal not only with emotional pain, but also with urgent financial deadlines. The government frames this as closing loopholes for billionaires, yet most of the impact falls on ordinary households. Middle-income families are effectively taxed twice, once when earning the wealth and again when transferring it. The greatest irony is that this law may erode the very foundation of generational security. Instead of passing on a home free of debt, many families may be forced into selling cherished properties just to satisfy the new estate requirements. Wealth inequality widens because those with access to elite accountants and complex trusts can avoid much of the burden, while ordinary citizens cannot. The result is a slow but steady erosion of family legacies across the country. By labeling inheritances as taxable windfalls, lawmakers ensure that what should be a gift becomes a trap, and what should provide stability instead drains future generations. Number 1. Digital asset taxation, the silent drain on your wallet. The rise of cryptocurrency and digital investments promised freedom from traditional financial systems, but new regulations are rapidly reshaping that dream. Under the latest proposals, every digital transaction could soon be subject to strict IRS reporting requirements. This means that whether you sell Bitcoin, exchange Ethereum, or even use a crypto debit card, the government wants a piece of the action. For many everyday investors, what feels like a small gain on paper could trigger a capital gains tax bill larger than expected. Authorities argue this is about fairness, but the hidden reality is a massive transfer of wealth from small independent investors to the state. The new framework has already sparked concern that people who entered the market casually could lose thousands without even realizing the tax traps they have stepped into. Beyond reporting, the law pushes digital platforms to share user data more aggressively with regulators. Every wallet, every exchange, every blockchain transaction leaves a trace, and under these changes, that trace becomes a tax liability. If you purchased crypto years ago and forgot about it, the IRS may not forget. Imagine opening an email to tell you owe retroactive taxes on a coin you barely remembered owning. The complexity of calculating these liabilities is another hidden cost. Investors are now forced to seek out accountants or legal advisors just to stay compliant, adding another layer of expense. This financial burden is not limited to wealthy traders. It falls heavily on ordinary families who once saw digital assets as a path to financial independence. The bigger danger lies in how these regulations discourage innovation. By raising the cost of participation, lawmakers effectively lock ordinary citizens out of a financial revolution that was supposed to be open and accessible. If you cannot afford the legal advice, the accounting fees, or the endless reporting, then you cannot truly participate. What began as a movement to decentralize money now risks becoming another system where powerful institutions win and ordinary people lose. The law designed to capture hidden wealth may instead drain honest households, proving why digital asset taxation is the silent threat that could cost you everything. We've just uncovered 10 laws that could change the way millions of Americans live, work, and save. From digital asset taxation to federal consumption taxes, each one carries hidden costs that strike at the core of family security. What makes these laws so dangerous is not just their complexity, but the way they disguise financial burdens as progress. Whether it's rising property taxes, shrinking retirement access, or unexpected student loan offsets, ordinary people are left with fewer choices and heavier obligations. The pattern is clear. Systems meant to provide stability are being reshaped into traps that quietly erode wealth. But awareness is the first line of defense. By understanding how these changes affect daily life, you can begin to prepare by planning smarter, seeking advice where necessary, and refusing to be caught off guard. These laws remind us that financial independence is never guaranteed. It must be protected with knowledge and vigilance. While lawmakers present these policies as solutions, their consequences reveal the need for ordinary citizens to stay informed and engaged. The future may look uncertain, but being proactive gives you power. By paying attention today, you can safeguard tomorrow. And while these laws may seem overwhelming, the most important step is recognizing their impact before they take hold, because once they do, the cost could be everything you've worked for. Share your thoughts below. We read every comment, and if you missed our last video, watch it next for more insights you won't want to overlook. We put enormous effort into creating these videos, so please support us by subscribing. It's just one click, but it means everything to us.